Well, good morning. We have so much to talk about. I know last week was a power week of information, and next week will be more of the same. We've got CPI next week, the Fed meeting next week. We've got some big data points that are going to move the market. And I know Megan's got a lot to fill us in on, as well as some of the things leading us into a recession and what that means. That's what we're going to be talking in the back half. Megan's going to take over. But here's my quote for the day. It's actually a double header. I've got two quotes because they work so perfectly. So I get up at 3:30 every morning. You know that. So Eric Long, my sales manager, has been striving to get up earlier. He woke up at 3 or 3:30 a couple mornings ago, and he came in and he told me at the office, and he said, yeah, I got up at 3:30 and I looked at the dog, and the dog looked at me, and neither one of us knew what to do with it. I'm like,
I can't get up that. It makes my day so long when I get up that early.
Yeah, but
what am I going to do with myself all day long? I can't get up that early.
But you get so much done between 3:30 and 8. Like the world is still sleeping and you're getting it done. So here's my two quotes really quickly. The degree to which you accept responsibility for everything in your life is precisely the degree of personal power you have to change or create anything in your life. And this quote comes from the Miracle Morning. I'm teaching a couple of classes in January on the Miracle Morning. Mm-hmm. There's so much noise and so much disruption going on in the market right now that you can either choose to be the victim of it, or you can take control of it because you're accepting the responsibility for what you can change. And then here's a quote that came from success.com. Successful people aren't born that way. They become successful by establishing the habit of doing things unsuccessful people don't like to do, like get up at 3:30 in the morning.
No, it's not happening in my house. It's just not happening.
I get that.
I'm a terrible morning person. I wake up and I'm like coming to grips with the fact that I'm alive in the morning.
So find one thing. So maybe not 3:30. If you right off the hip, what would you change one thing habit?
Oh, for my morning routine? Oh gosh, if I could get up at 6 and just kind of hang out and mellow and watch the news for 30 minutes
before the
crazy starts, I would like that. So I can catch the weather, catch the traffic, catch some of that stuff. 6 o'clock is probably about as early. That's about as early as I can get up. It's about 6 o'clock in the morning. And I'm taking tomorrow off. So I'm sleeping in.
Monday morning, 6 a.m. Well, that's the thing. It's this, find the one thing. How can you change or adapt your morning? How can you add one habit, or how can you stop one habit that you know is not leading you to success, that is disruptive, or it's a bad habit, or it just pulls you away from the things that you need to be focused on? This is the time. It's December. It is the golden time to rethink your goals and your activities that are going to lead to success next year. Mm-hmm. It's a great time of year.
It is a great time of year.
And you're going to the Gaylord, which is just beautiful.
This weekend. It's going to be super fun. Yes. We've got tickets to all the shows. We're going to decorate gingerbread houses. We're going to go swimming. It's going to be a fantastic weekend. I'm nervous about food though, because I've heard that the food lines are just insanely long.
You don't want,
and so I'm nervous about having hangry little children.
Hangry children are not good.
No, they're not good.
And the Gaylord, I got to tell you, only for kids. I took the whole team there last year, and it was a madhouse. It's just nasty little critters are running around.
Oh no, we're all gonna get colds this weekend. I mark my words. That's what's gonna happen.
But it'll be fun.
It's so much fun. It'll be so much fun.
So why don't we kick us off? What's going on with the market?
So let's go ahead and pull up the PowerPoint slide deck, and we'll get this going. Whoops. Let's see. Did I share that right?
Yeah, I think so. Well, we're about to find out.
Yes, I think I got it. Okay, cool. So this covers the week of November 30th through December 6th. And as you recall, last weekend, we were talking more about what was happening over Thanksgiving weekend. And there was a really big lull that happened over Thanksgiving weekend. So if you were a buyer and you were out over Thanksgiving weekend, you had your pick of the litter. And so I was surprised to see the number of transactions that actually came in over that weekend, but it was definitely down by about 40% from previous weekend. So what we were looking for coming back into this weekend is if the market was going to rebound or not. And so we did have a really nice rebound rebound this weekend, which was great. My order count was fantastic on Monday, so I was really thrilled to see that. But people were definitely back out and looking at the market again. And so looking at our heat map for what happened in 2022, we ended up seeing a little bit less of that blue color, but you can see how blue Thanksgiving week is, indicating that week was the coolest week of our year so far. But then it lightened up a little bit after that, and so it ended up being a really nice beginning to the week where things picked back up again. And so our active inventory, as you can see while we're watching this, I'm looking for this decline of active inventory as we get into the later part of the year, because how low that inventory goes, it's really what drives our spring market. So we need that number to drop off pretty drastically in order to have that big kickoff to our beginning of the year. Now, I'm not anticipating a huge pickup in January or February. I'm really expecting it to happen in March. And so I'm hearing a lot of people say, well, do I wait now? Do I buy now? Do I wait until the spring when there are more choices available? And I would say start your hunt now, because you've got more negotiating power available to you as you get deeper into the winter months. And the people who are listed right now want to sell right now.
Need to sell.
They need to
Yes.
sell right now.
Yeah.
And so you'll have a better chance of getting those inspection resolution items taken care of. You'll have faster timelines because there are fewer transactions that are happening right now. And so I would say get into the market now, but know that is come spring, that if our inventory continues to drive off at this drastic rate, like what we're seeing right now, that we'll probably end up having a nice quick spring that'll probably pick up in about March.
Let's talk about that for just a second too, because if you overlay the interest rate expectations, so what we're going to see, right, the Fed is going to raise the Fed rate again next week, as we expect, and then again in February and again in March. So and we're heading into a recession, which we're going to talk about on the back half. So if we're heading into a recession and interest rates are still in flux as inflation is trying to get controlled, then you're going to see sellers who would be buyers waiting. And then you're going to see the slow pickup in January and February. And then if we do see this pickup in March, it's going to be on a lesser inventory based on everything you're seeing. So we're going to see more demand come out. And then all of a sudden, you're going to have this accelerated amount of demand entering into the market at the same time the inventory is going to be hitting a low, and it's going to increase prices.
Yes.
Right. So we've got this like 3-month sweet spot right now.
Yes.
Isn't that? I mean, it's
exactly.
Like we need to be talking about that.
Yes. And so if I were a buyer, I would definitely be looking right now to see what's in the marketplace. And there still is this really interesting hotspot of activity that's happening in these multi-million-dollar markets right now.
Wow.
And so they're less sensitive to what's happening with interest rates. And so those markets are actually outperforming what's happening over the market overall. Now, active inventory came down to 6,000. That declined week over week by about 4.9%. New listings shot back up. Again, you don't see a lot of listings that happen over Thanksgiving weekend unless they have to list. And so that's why that number is so high. We saw 565 new listings hit the market, but that's down from 35% from the same week 1 year ago. So our new listing activity is really what's driving down our active inventory and this purge of expired and withdrawn transactions. As you can see, our expired listings came up to 456 listings expired last week. That was an increase week over week of 230%. And it's an increase from the last year of 456%. And so again, we're looking for that big dive of inventory to head us into that spring market. Withdrawn transactions were up by 21% or up 159.8% in favor of last weekend. And so these are people pulling their listings from market probably over the holiday period and then waiting to list until next spring. And so again, what we're expecting to see is this big purge of expired and withdrawn transactions. That's exactly what I wanted to see headed into this week.
And last year at this time, though, you had the hungry hippos, right? I mean, so last year at this time, nobody was pulling them. They didn't expire because they were sold.
Right. Yeah. Because they were going under
totally
contract and closing within a week. So that brings our predictive month supply of inventory back down to 2.1. We were at 3 over Thanksgiving weekend. So again, that number shot back up just because there was a drop in demand. And so our demand picked back up and we're now back down to 2.1, which is exactly where I wanted to see that number fall back down to. So that means for every one buyer in the market, they have about 2.1 homes to choose from right now. So again, not a lot of choices out there, but still, it's still considered to be a seller's market. Every once in a while, I'll see a TikTok feed pick up or an Instagram feed pick up, or someone says or declares that we've trended into a balanced market or that we've trended into a buyer's market. We're still not in a buyer's market. We've just gone from running 120 miles an hour down to the speed limit. And so we're now still sitting in seller's market territory at 2 months worth of inventory, but it's so much less extreme than what we experienced throughout 2021. 2022 has been definitely a year of shift for us.
And what's normal for the Denver market? So if 2.1 is still a seller's market, we know that. What are you typically seeing in that?
So over the last 15 years, we've
Yeah.
averaged about 3.5 months worth of inventory. 6 months of inventory would indicate that we've transitioned into a buyer's market, and we're nowhere close to getting into a buyer's market at this point. Buyers definitely have more negotiating power. I'm still seeing a lot of price reductions, but that's from people that were pricing off of peak pricing strategies back from March, April, and May. And right now we're off by peak pricing by about 11.6%. It's less at higher price points because they're less sensitive to what's happening with interest rates. About 40% of transactions are cash transactions over $2 million right now.
Yeah.
And so our $3 to $4 million market and our $4 to $5 million market are really rocking right now, considering how high priced those homes are.
Right.
They're really doing very, very well, even in light of the shift. We saw that our odds of selling popped back up to 42.8%. The weekend before Thanksgiving was a little bit better than the weekend after Thanksgiving, but we're right back in there with where we should be for this year. We're off by about 10% from what our average has been from 2013 through 2021. Historically, the odds of selling in December are about 53%. We're down to 42.8%. So if you list a home this week, getting it under contract and or closed in the month of December, based on this data from this last week, you've got about a 42.8%. But that was a 6% increase over where we were last week. That number dropped down to about 36% over Thanksgiving weekend. So that's again why we don't list over these holiday weekends.
Right.
Don't list the week between Christmas and New Year's. Wait until after New Year's. Ideally, that sweet spot, if you're looking to list, is that weekend directly following the Super Bowl. Not that we have a chance, and it's usually when after the last game is played by the Denver Broncos,
Right.
which is going to be early this year.
I'm so sad about that.
That was such a heartbreaking season. I was so excited. I was like, I'm going to buy tickets to every home game. I was so excited for it. And it's just not happening. And now tickets are going for what I paid for preseason tickets. I went to 2 preseason games, and now they're selling for preseason ticket sales. I'm like, I don't even want to go. Looking at where we are for percent of balance, we popped back down to 34.2%. So that's where we were just before Thanksgiving weekend. Thanksgiving weekend, we actually popped up to 49.6%. So we had a nice little sweet spot in there. For those of you that were out hunting for deals over Thanksgiving weekend, you had a great opportunity to get something under contract over Thanksgiving weekend. But now we're back down to 34.2%. So we would need to have about 17,500 total active units available for sale to get us to a point of balance before we truly flip into a buyer's market. So we're not looking for signs of a market crash. Do you want to know how many distressed transactions there were last month?
I'm gonna guess one.
Yeah, there were 2.
Oh, there were 2.
There were 2. There were 2 HUD properties that sold last month out of the 3,000 transactions that we closed. So we're not expecting this big wave of foreclosures, short sales, HUD homes. It's true that some people who bought their home earlier this year might be upside down on their home, but don't sell. Just don't sell. And then you won't realize that loss.
You know, to see that though, that huge trend, which we talked a little bit about it last week, because you were like, this is not normal. It's going to come back down again. But to see that, it's like you always know the sweet spot after it's passed.
Yep.
Is what I keep thinking about. And it's like, we're talking about the next 3 months, like they're gold. Don't let your buyers let them pass and go, dang it, that was the time I should have bought.
Yes. Even though interest rates are higher, you have negotiating power where you're able to get, it was like 58% of everything that closed last month sold for under asking price. So you've got negotiating power to go for under asking price, plus get those inspection resolution items taken care of. This is really a sweet spot in the market if you're a buyer looking to take advantage of the market.
Absolutely.
Looking at showing activity for this last week, we popped back up. Showings increased week over week by 65.1%. We sat just underneath 10,000 total showings. So it was about 1.6 shows per property per week. So if you're not getting 1.6 shows per property per week, you might not be in the sweet spot and might want to start considering a price reduction. So we're looking at about 1 or 2 showings per week this last week. Shows to contracts popped up to 14.6. We'll call that 15. So 15 showings should yield you an offer. Buyers are taking a little bit longer to look at properties. They're looking at more properties before going under contract and exercising their right to choose. They don't feel like they have their feet to the fire, unlike what we experienced for the first 4 months of this year. So about 15 showings should yield you an offer at this point in the marketplace. Median days on market popped all the way up to 34. The last time that we saw 34 median days on market market was back in 2019 at the beginning of the year. And so we ended up seeing that was also the time that we saw interest rates go from 3% up to 4.5%. And so again, we're looking a lot like 2019. And I'm really struggling with how to put together projections for next year, because I'm going to have to remove the COVID years, because the COVID years were really exceptional years. It just doesn't make sense to use those years anymore. So I'm going to be focusing in on 2013 through 2019 for those averages in order to put together more realistic expectations as to what's going to happen with the ebb and the flow of our market. But we're up to 34 median days on market right now. So just over a month to get your home under contract. That's not bad considering the average going back over 15 years is about 60 days. So it's still about half the time to go under contract.
Can you say that again?
The average over the last 15 years is about 60 average days on market.
And 34 seems so long.
And 34 feels like forever nowadays. And so it takes about 34 median days on market. So again, if you've been on the market for a month, then you might be time to make a price reduction at that point. Last week for pending transactions, we saw that 59.1% of everything that went under contract made a price reduction. That increased week over week by about 4%. So we're seeing more frequent price reductions, and price reductions tend to grow as we go into December. So we'll see more of those price reductions for people trying to get their home under contract before the end of the year.
Really quickly on this, I was thinking about this week, that if we're seeing these price reductions, and we will continue to see the price reductions through January, possibly through February, until the rates drop and we see the excess demand coming in and pushing prices back up again. I bring this up because if you have a first-time home buyer that doesn't have a lot of money, I would expect that the appraisals are going to come in low, right? Because if I've had months of people doing price reductions to get their offer, and now all of a sudden I have multiple bids and we're going above asking, now all my comps were lower, right? With seller concessions and all the things that were happening. So that's something that we got to take into consideration, because not only are you going to spend more than asking, but you're probably not going to get the appraisal to back it up. So you're going to have to bring the cash.
Right.
So super important to be having those conversations, especially with your first time home buyers.
Definitely. Speaking of concessions, I went through and pulled out the concession information for, and it's not published in the report. I'm still struggling with trying to get all of that concession information together for you. Historically, I got to take more breaths. Like I'm running out of air. I gotta breathe.
So much
use the diaphragm, use my diaphragm. And so
need more cardio.
Yes, I do need more cardio. I'm not even moving and I'm out of breath. And so looking at concessions for last month, it was 57% of everything that sold last month sold with a concession. And the average concession was just over $5,700. And that was used for closing costs or points paid down is what we were seeing for concessions last month. Looking at the size of the price reduction, the size of the price reduction was about 7.2% off of the original price, or about $48,000, $49,000 off of the original price to get a good price reduction in there. For homes up to $500,000, we saw this market pop back up again. We ended up going from 1.9 months worth of inventory over Thanksgiving weekend down to 1.3 months worth of inventory. Our average daily active count came down by 4.6%. And again, we saw a big purge of expired transactions. They jumped by 275% over where we were 1 year ago, and withdrawn transactions were up 135%. So our month supply of inventory came down to 1.3 months worth of inventory. So this market is still really tight and really competitive depending on where you're looking in Metro Denver. There were some really interesting hotspots this month when I pulled out the heat maps for where we're looking at the lowest month's worth of inventory. Highlands Ranch continues to be a hotspot on my heat map where we're continuing to see multiple offers that are happening down in that Highlands Ranch area. And interestingly enough, our foothills communities are still doing very well. So Conifer, Evergreen, Pine, Golden are still very hot spots in our marketplace. There was another little hotspot up in Thornton between about 120th and 144th.
Explain that one.
At lower price point.
Oh, that makes sense.
Entry level homes.
Because the mountain area makes sense to me because it's a lifestyle choice. Right? Especially this time of year. But Thornton,
and those foothills communities really heat up over the winter months because inventory goes down. We've got all of the people coming here for ski season. They're like, wow, this is great. I'd like to buy a second house. And so they're looking at Conifer, Evergreen, and Pine to get a second house for the winter months so that they can live out here and enjoy the lifestyle.
Be close to Denver.
And still be close to Denver. Odds of selling popped up to 53.3%. It dropped down to 47.6% over Thanksgiving weekend. So it increased by 5.7%. It's still down from where we were 1 year ago by about 30%. But overall, if you list a home this week, you have got about a 53% chance of it going under contract and or closing in the month of December. Percent of balance came way back down. So we dropped from 30% over Thanksgiving weekend down to 21.9% over this last weekend. And so we would need to have about 7,752 active units in order to create that market imbalance. So we only have 21.9% of a balanced market here in this sector. 2.4 shows per property per week. So if you're not getting your 2.4 showings per property per week, maybe time to consider that price reduction. We're looking at about 14 showings to go under contract. So again, people are looking at more homes before they go under contract, even in the under $500,000 market. Median days on market stretched out to 29. I'm surprised to see this number as high as it is, considering how tight our market is, but it was 29 median days on market. So if you've been on the market for about a month, maybe time to consider a price reduction at that point. Based off of what went under contract this last week, it was 58% of them made price reductions. And so that was increased week over week by about 5.2% for people going under contract.
But don't you find, like, if you have that kind of severe price reduction, you were probably on the market longer. And so that kind of mirrors the days on market median being longer, because if people were really holding out trying to sell for that higher price, or maybe they weren't curb appeal or weren't staged right. I mean, those numbers kind of go together, don't they?
They do go together.
Okay.
Yep. The longer that you're on the market, the more likely it is that you'll make a price reduction. Average price reduction was about 7.2% or about $32,000 off of the original asking price. Now our $500,000 to $1 million segment, this is our most interest rate sensitive segment of our marketplace, with about 85% of them requiring financing to get into a property. So this is one of our more volatile price ranges, but it did pick back up nicely as we were looking at the $500,000 to $1 million segment just this last week. We did see some interesting movement, and we see this nice curve of inventory declining as we get into November and December. So that's a good thing to see that market being driven back down to hopefully kick off our spring months. But we went up to 3.6 total months worth of inventory over Thanksgiving week. It's popped back down to 2.3. So we're back to where we were just the week before Thanksgiving. Our average daily active count came down by 5.1% this last week, and our expired transactions were up 582% from where we were the same week 1 year ago. Withdrawn transactions were up 176% from where we were 1 year ago. And so again, this nice big purge of expired and withdrawn transactions is really what drives our spring market to get those listings off of our books in favor of waiting until next spring. The odds of selling popped back up to 40%, not quite where we were at 44.1% the week before Thanksgiving. So the moral of the story is that if you're trying to figure out when to list around a holiday season, there's more activity the weekend before a holiday than there is the weekend directly following a holiday, especially in the winter months. So if you would have listed in November, it would have been better to get on the weekend before Thanksgiving to get that pop of activity, slowed over Thanksgiving weekend, and then it picked back up over the weekend directly following Thanksgiving. But the odds of selling was about 40% in this particular market. It increased week over week by about 6.8%. Percent of balance also came back down to 38.3%. It was 37.6% the weekend before Thanksgiving. It went up to 60% over Thanksgiving weekend. So again, those buyers that were out there over Thanksgiving weekend really enjoyed having some good, strong negotiating power. Looking at shows per property per week, we're looking at about 1.4 shows per property per week in this particular price segment. We ended up seeing that was about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, it's time to make a price reduction. And we saw median days on market stretch out to 41. That's a really big number compared to the rest of the price segments. This is our slowest market overall. Again, due to higher interest rates, it's really slowed down this market, but it was 41 median days on market. So if you've been on the market for 41 days or longer, it may be time to make a price reduction.
Now, in this days on market, is it calculated based on closings during this past week or going under contract?
Going under contract. So I want to try and get you the most current information possible. So I use pending transactions for this report so that you can see exactly what happened just in this last week.
So even with the dip in rates,
even with the dip in rates, it was still 41.
Yep.
And so again, having Thanksgiving week on the books, we might see this number drop off a little bit as we get into the next couple of weeks, getting post Thanksgiving weekend. But again, those properties that were listed over Thanksgiving weekend probably added about 7 median days to their average days on market because there was such a dip of activity over Thanksgiving this year. 60.7% of what went under contract last week made price reductions. So there were some pretty significant price reductions with an average price reduction of about 7% or about $50,000 off of their original asking price. 1 to 1.5 million, this only represents 7.6% of our inventory. We did see this market pick back up again over Thanksgiving week. Month supply of inventory jumped all the way up to 5.2 months worth of inventory. So it trended towards a balanced market over Thanksgiving weekend, and our month supply of inventory drove back down even further below where we were leading into Thanksgiving weekend. And so this market only saw 2.2 months worth of inventory in this market. And is that lower? That was lower than what we saw in the $500 to $1 million segment.
Yes. Yeah.
And so our average daily active count came down by 3.5%. Look at these expired and withdrawn numbers compared to where we were 1 year ago. Expired transactions jumped by 820% and withdrawn transactions jumped by 500%. Again, we're dealing with much smaller numbers here, but people are pulling their listings for market, driving our inventory down, which is going to kick off our spring market very nicely. The odds of selling popped back up to 38%, not quite where we were the weekend before Thanksgiving at 40%. That's not surprising. I typically expect the odds of selling to decline as we get later into the year, and it really bottoms out that week between Christmas and New Year's Eve. We only have 23.9% of the inventory required to offset demand. Man, people really took a break in this market over Thanksgiving week. It was up to 58.2% of balance. And so again, driving that number back down with our pop of weekend activity directly following Thanksgiving week. We saw an increase of showings. That increase week over week, it nearly doubled. 591 total showings were set. So we're looking at about 1.3 shows per property per week in this particular market. We're looking at about 13 showings to go under contract. So interestingly enough, this market is more competitive. So people are looking at fewer homes before going under contract in this market than the under $1 million market. So this market is less sensitive to what's happening with interest rates.
And people keep talking about affordability here in the Denver market, and I get it. I 100%, you can't disagree with the fact that it has become less affordable, but to see these numbers and see the continued demand at these higher price points tells you that the population shift. They're either making more money, wages are going up so they can afford these homes. They made more equity on the homes that they're selling that they can afford these homes, or they're moving into the area from other areas where they can afford these homes.
Yes.
Either way, affordability continues to be a conversation, but the data tells you that it is not an issue.
Yes.
Right? To some degree.
In the over $1 million segment, affordability isn't an issue. They're much less sensitive to what happens with interest rates. But that $500 to $1 million mark, where it's 85% of them require financing, that market is feeling it, definitely. But it was about 13 showings to go under contract this last week. Looking at median days on market, it stretched out to 37.5. So it was interesting to see that number continue to trickle upwards. That's significantly higher than what we saw over Thanksgiving week, which was 21.5. So we're looking at about 38 median days on market. So if you've been on the market for 38 days or longer, it might be time to make a price reduction. Exactly half of the homes made price reductions this week. So it was 50% made price reductions for those units going under contract. And the average price reduction was larger at 9.5%. And so we saw about $131,000 average price reduction, $132,000 average price reduction for 1 to 1.5 million. That's a big price reduction.
That's a lot.
Looking at the 1.5 to $2 million market, we ended up seeing that this market picked up just a little bit. Looking at our month supply of inventory, we ended up going from 4.4 months worth of inventory over Thanksgiving week to 5.9 months worth of inventory. So this market isn't coming down quite like what we're seeing in the $1 to $1.5 million market. We're still seeing that nice curtail of active inventory coming off of our books, hopefully getting ready for spring, but our expired listings were up 600% and withdrawn transactions were up 20% over where we were 1 year ago. We had no coming coming soons last week. So that's why this divide by 0 is in here for coming soons, but 5.9 months worth of inventory. So this market is trending towards more of a balanced market. We had 24.6% odds of selling in this market. Looking at where we are in terms of balance, we're sitting at about 49% of balance right now based off of what went under contract last week. We'd need to have about 365 total units available for sale to really trend towards a balanced market. We have one show per property per week. We're looking at about 26.1 shows to go under contract. So this market didn't have the big pop of activity like what we saw in the $1 to $1.5 million market. So people are looking at a lot more homes before going under contract. 50 median days on market in this price range. So again, a lot longer on the marketplace. That doubled going from Thanksgiving week into this last week. It was 50 median days on market. 71.4% of homes in this price range made a price reduction, with an average price reduction of about 11.5%, or $220,000 off of their original asking price. And so significant price reductions in that $1.5 to $2 million price point. We've got a couple of questions. We'll run through these really quick. Can you repeat the two properties that are distressed versus how many properties were under contract and sold? So there were about 3,000 total closed transactions last month. There were 2 HUD properties that closed last month. So again, no foreclosures and no short sales. Are you able to tell the difference between investor purchases versus buyers that intend to own or occupy? Curious about how many investors are in the market buying properties with cash and taking advantage of low multiple offers. And so I can't track if they're owner occupied or not, but I can track cash transactions. And last month, 20% of all the transactions that were purchased using cash. So 1 out of every 5 was purchased using cash. Buyers are seeing more properties and waiting before making an offer since we are seeing so many price reductions. Thoughts? Are homes still being listed overpriced, and is our market still adjusting? I think our market is still adjusting because affordability got so far out of whack with interest rates going up. It's now about 50% of your average household income goes to make a median household payment for about a $729,000 priced home. And so again, it's taking a lot more. So affordability is still adjusting right now, and people are still pricing off of peak pricing strategies. Can you remind us the number of units for a balanced market? It's 6 months. And so we would need to have about 17,000 available listings for sale in order to keep a market in balance. With that said, we'll turn it over to Nicole for her part.
Here we go. So we're going to talk a little bit about the recession. We're going to talk about some really creative financing, a couple of deals that we got in this week that you need to know about and have in your back pocket in case you're getting a no from another lender. We're getting deals done that other lenders can't, and what's with this little product that I'm going to share with you. And then at the very end, I'm going to give you 3 topics. If you're calling your sphere this week, as you should be, whether it's pop buys, whether it's dropping off some sweets, or whether it's just checking in on them. I got to tell you, I went to the dentist yesterday. My whole lip was numb all day. Talk about a pain in the butt. I was really glad I didn't do it this morning. So I did this. So my dentist texted me this morning and he asked me how I was doing.
Oh,
I have never had that happen before.
that is so nice.
Right?
That
and
is
I'm
so
not
nice.
giving you his name because he's already full. So I'm kidding. No, but I was thinking about that. I was like, the elevated customer service right now that needs to be happening in this market. If you're calling your clients, you just had a meeting with them, you're checking in with them the next day, any questions that you thought of overnight, or you're touching base with them, I'm going to give you 3 topics that you can talk about at the very end. So stay through the end and let's just jump in here because, wow, so much to talk about. So many open doors for conversation. That's how I continue to look at this. I just need to share my screen and then we're going to go. Okay. So did the 2 quotes. We're going to jump through these really quickly. So we have these, we always do provide the PDF of our slide deck in our Agent Ignite Facebook group. If you're not a member, you need to be. I know that Megan sends out her slides via email. I also send out an email talking to you about the things that are happening, as well as a link to the Agent Ignite Facebook group so that you can download any of the slides that I've got that help with you with social media. And then of course, Megan's data, a massive ability to have a conversation around what's changing in this market elevates you to advisor. It removes you from being the real estate agent that's opening doors, or the lender that's quoting a price, or even a title agent who's getting to the closing table. I mean, that's great, but that's our job. Like, your job is to get them to the closing table.
Yes.
My job is to get you closed on time. Your job as real estate agent is to find the home. It's all the other stuff, which is the value add that we bring, and capitalizing on this data is so huge, right? Use it, please. Quote us, hashtag us, tag us, do the thing, but please share this information, because if it helps you, it helps all of us. Trust me, even not those of us, the two of us and you in the room, but it helps the entire real estate market to elevate the knowledge around what's really happening, instead of the fear mongers who are doing the headlines in the news. All right, so recessions. The recession is coming. We're talking about now, it has a 43.5% probability. The Fed keeps talking about a soft landing, but I'm looking at this going, this is the highest probability of ever having a recession. And why am I celebrating that? Because hell, we've been in ours. Like, it's time to share. So I just want to say that we need the rest of the economy to go into, whether it's a soft recession. I don't think it's going to be long, and I don't think it's going to be deep, but I think just enough of it needs to happen to slow down the economy, slow down demand, slow down spending, which slows down inflation, which drops our mortgage rates along with other bond yields, right? Which benefits all of us here on the Zoom today. So let's talk about a couple things. So ADP came out last week. We talked about this already. It was a miss. And we talked about the fact that we were expecting the jobs numbers, which came out on Friday, to also hopefully be low, but they weren't. But this ADP miss is the thing that gave us that really nice drop. Remember, we were celebrating last week.
Yes.
We were, and I enjoyed it. So we were celebrating that nice little drop, and then it's really been flat. So we saw a little bit of a dip, but we're really just seeing volatility at this point, because the next couple of days, the BLS, which is a non-farm payroll, was actually up 263,000, which made no sense. But these are surveys. So the BLS is based on businesses that are born and closed, born and dead, which were opened and closed, and based on the average number of employees that work at those types of businesses. And then there was a household survey that also went out that went into the unemployment number. The unemployment number stayed at 3.7. The market didn't react to either one of these, except for it just didn't really continue to celebrate. The celebration was over on Friday. So on Thursday, we did it. On Friday, it was over. We also talked about the PMI. So the Chicago PMI, we talked about the New York, the Chicago PMI, which is the manufacturing index, is also in a recession. And if you look at this, it's consolidating. And when it does this, not expansion anymore, because it's under 50, which is the index. When it does this, the last two times it did this, it was the dead ringer of the indicator that told us that we were heading into the recession. So this recession is coming. It's just a question of what does it look like and the extent to which it affects the pain level, right? We all remember when Powell came out saying we need pain to be caused to business owners and households. And dang the people who are head of households who are business owners, you get the double whammy. So we also saw the yield curve inversion. And not only is it inverted, it is deeply inverted. I got to go all the way back to 1980 to see this kind of deep inversion. And why is this? What exactly is happening? Remember, if I loan you $1,000 and you're going to hold on to it for a longer period of time, I would expect your interest rate to be higher. You're holding my money for 5 years, 10 years, 30 years, versus if I'm doing a short-term loan for a year, I'll give you a better rate because then I can capitalize on that money that you pay me back, right? It totally makes sense. That's not happening right now. We're seeing the short terms are actually higher than the long terms. And the short term is mostly propagated by the Fed rate. The Fed rate is going up and it will continue to go up 50 bips probably next week, and then 25 in February and 25 bips again in March. So that's pushing up the short-term rates. The CD rates, savings rates are higher right now. We talked about getting the 1-year treasury yields on the Fed website. So those short-term rates, credit card debt, car loans, the savings rates, all HELOCs, gosh darn it. You guys got to be protected. If you've got a lot of money sitting on a HELOC, you've got to know that that interest rate is going to continue to go up next year. And then it's going to stay flat until probably the end of next year before it starts to come down again. So you've got to be watching that. But the long-term rates are dropping softly. Why? Because inflationary measures are continuing to come down. So this is the gas. So would it surprise you to know that the gas right now is only 5 cents more than it was a year ago?
Oh my
Are
gosh.
you feeling it? So gas
Cost me like $80 to fill up my car.
You have a big, yeah. No, I have an electric. Haha.
Oh my gosh.
Although I got to remember, hey, Peter, side note, I got to plug in my car tonight. I got 10 miles left. So
That would stress me out so much. That with the amount of driving I do, I would be so stressed out
you
all the
can't just like
time.
run into a station and plug yourself in.
No.
It doesn't happen that
No.
fast. I need a sticky note. So gas is down. It's only 5 cents more than it was a year ago. We're seeing the supply chains are easing, which means shipping costs are going to ease, which means manufacturing prices are going to come down. The producer price index comes out tomorrow for the first November data. So really be aware of what that says. If that's lower, now we're starting to see a trend. PPI comes out tomorrow, and that's the producer's price. And that's really affected by the shipping costs and all of that, because that's all wholesale as it leads into more of the retail, which is the CPI, which comes out next Tuesday. So we've got a lot of headlines coming out that are going to tell us, was last month a fluke? Was it just a nice gift, or was it a beginning of a trend, right? I'm starting to think we're seeing a sea change here, and I'd like to see a little bit more data points to tell us that, but that's really going to confirm what we're going to start to see in February and March, and the message you need to be putting out to your consumers. We're also seeing rents coming down, all the indicators. This red one, interestingly enough, is the PCE housing. So it's actually what's in the PCE, which is the Fed's preferred measure of inflation. So that's like a lagging indicator. And they're like, this is like, what is that? Like months and months outdated. So it's going to start to crest, and it's also going to come down. As that comes down, we're going to see that inflationary number come down, because housing, remember, is 40% of the core inflation numbers, not the headline, which includes the gas and food, but it is 40% of the core. And as that starts to come down, inflation will come down. We're also seeing framing lumber coming down to pre-pandemic numbers. So that's great news for builders or anybody building a home. You know what else is coming down? Liquidity. The spike, the sugar high, the massive number. When we saw a 25% increase in liquidity in 2020, that was higher than any increase since it began getting tracked in 1959.
Wow.
Now to see a negative for the year is the first negative seen since 1959.
That's crazy.
This squeeze is what we're seeing and feeling. It's this squeeze that's slowly slowing down demand, because we're still seeing spending, and just shifted it into credit card debt, right? But this is doing all the things as far as slowing down inflation. So that's a good thing. The extremes, not so good, but the fact that it is slowing down is good. So Jamie Dimon came out talking about the fact that consumers are spending their excess savings. That liquidity has softened, it's shrunk, and now they don't have access to it anymore. Now they're having to dip into all that savings. And he goes on to say that that savings that was excess will be gone by next year, which then pushes us into this recession, because spending slows down, then prices come down, then inflation comes down, then our mortgage rates come down. I'm just going to keep saying that. So
I know,
this is
that's
the thing
what
that
we
we
want.
need. It is
That's
what we need.
want.
So we're going to run out of all that excess savings. In fact, if you go to Fred and you look at this massive excess savings that we were seeing in 2020 and 2021, because of all this liquidity, has now dropped down to only 2.3% savings rate, which it only was matched once in 2005 and not since. So they're working all the way through their savings, which we're also seeing those credit card debt levels increasing as a percentage. So where the liquidity goes, so went the housing prices. So to see this chart, to actually see where the money supply was ramping up, so goes the housing prices. Because with the liquidity, people had money to spend. Oh, that home cost $50,000 extra? Okay.
Yep, got it.
Oh, that home cost $200,000 extra? I have that.
Yeah.
Right? All of a sudden, it's a mindset shift. And so I'm not saying that $200,000 is funny money. It is not. It is real. But when I feel very wealthy, which is what was happening between crypto and the stock market and people's savings accounts, all of a sudden that home was now worth a lot more than it might have been to me had I not had this abnormally high amount of liquidity. So as we're seeing the liquidity start crunching down, we're seeing the home prices soften as well. CoreLogic just came out. Denver is now running year over year 7.8% increase in appreciation. Remember, this number is always going to be a little bit off because it's not median and it's not average. It's actually the increase in the home prices specifically every time they turn over. Nationally, we saw 10.1%, but here's the number. So they're actually forecasting 4.1%. Now you've got a gamut. Some people are estimating at 0. Some people are estimating 4 or 6. All I know is that in 2019, I had a pretty good year. And in 2019, we saw 2. So this does not scare me at all. In fact, it makes me feel better because I need this. We need this so that those home prices can settle in, so more people can get in, so affordability comes back in check and allows wages to continue up. With interest rates going down, it allows more people to come into the market, right?
Yep, we need this.
And we're going to see this. So this turbulence in this market that we were talking about right in the very beginning is going to go through the first quarter. We're going to see still a lot of market volatility. We're still going to see interest rates finding their groove. We're going to still see slow demand. We're going to see sellers who would be buyers holding off, waiting to see what happens. That second quarter is going to be that transition where some people are like, oh shit, I think I missed it. I got to hurry up and get listed, or I got to buy. And then the second half of the year is going to start to turn into whatever that new normal is, right? I hesitate saying back to normal, but whatever that new normal is, we're going to start to see what that looks like the second half of 2023. I'm even seeing some hearing some conversations about the Fed, then even reducing the Fed rate slightly in the second half. It's a little bit early to count our chickens on that one, but certainly those are the conversations leading into more of a normalized 2024. So all of this is good news. This is the thing. So mortgage purchase applications came up and they were actually down 3% week over week, but this is the exact same number comparison as the Thanksgiving week comparison that we were looking at with Megan. So those same comparisons are hitting the mortgage purchase applications. So the fact that it was down 3%, we'd have been up 5 weeks in a row. So I'm thinking that this is the bottom. So now that we're starting to see this, you've got to think that this is your 30 to 90 day window of pendings, right? So those people are putting mortgage purchase applications, they're looking, they're thinking about it. If the right one comes on, they're definitely going to get in, but those are really looking at January, February, and March. So if we continue to go up next week, it'll be really interesting because if that turns back around and goes up again, which I expect it will, then that really is kind of the bottom that we're going to start to see this new trend of mortgage purchase cap. But I mean, we're still super low. I mean, you got to go back to like 2014 to see this number again. So it's still low, but it's coming up. But 2023 is still expected to be a good year. It doesn't feel like it right this second. And I get that. But if you look at some of these expectations, and this is one of the forecasts, we're going to see all kinds of forecasts coming out this month and the beginning of next month. But if I just look at the blue bar, and the blue bar is purchases, I'm not talking about the refinances at all. But if I look at this blue bar, and if I exclude 2020 and 2021, and even with 2022, I got to go all the way back to 2005. It's going to be a better year than we've had in more than a decade. So when I look at that, those real estate agents, lenders, and title reps who are working the business right now, who are staying in communication with their clients and staying active and relevant, are going to have opportunities next year still. It's just not going to happen in the first quarter. So all of this is good news. It just means you have to continue to work your marketing plan. You got to create the plan, and then you got to work the plan. Hey, come on, get up early with me. 3:30 is not that early. Create the marketing plan. If you want, like, I'll text you, you just tell me who you are and we can get a conversation going.
This will be like your rate update text line, your early morning people.
Morning update. Hey, Cara, you set that up. I know you're watching. So we're going to call the early birds. all of us who are jumping in front of this and making sure that we're getting some of this market share that's going to happen in 2023. And why? Because I cannot stop saying it enough. The largest age group is 31. This just did not go away because they were priced out for 2 years, then feared out for 6 months, and now they're ready. This whole group is the largest swell ever. And look at this whole group is coming through. Guys, like, we have a great number of years in front of us. We were saying this in 2019 before the pandemic came, but it doesn't change the fact that they were born 31 years ago. So the average first-time home buyer age today is now 34. It moved up from 33. So this is still an incredible opportunity for all of us. And ultimately, even considering all of the 8 recessions that we've had since 1960, home prices always recover and always go up. In fact, I was getting into a conversation with one of the YouTube videos, and somebody was saying, well, how long did it recover? And of course, that depends on your metro. But here we recovered everything back by 2013, right? So very fast, all things considered. Real estate is long-term. We're not day trading homes. Although I did read an article that people were day trading Teslas.
What?
They were during like 2021 when they were so
my
hard to
gosh,
get,
so
they'd buy
crazy.
them. And I was like, yeah, I'm
That's-
really glad that we don't day
No.
trade homes.
No.
But I wish I bought a Tesla. No,
Yeah.
I actually don't. But there's a thing. So gonna go through a couple things that you need to know on the lending side, and then I'm gonna give you those 3 things that you can be talking about when you're calling your folks. So this is one of the things that you could be calling them, but it's not one of my 3. We can still close before Christmas if you go under contract and we get your loan application disclosed on the 14th. What's today's date? Today's the 8th.
Today's the 8th.
I'm giving you like 6 more days. I'm giving you 6 more days to go under contract and to get the loan disclosed. If we do it by the 14th, I can close you on the 23rd. It can still be a Christmas present. Now, I have even longer to get you closed before the end of the year, but I'm telling you, we're closing in 8 days consistently. In fact, we had 2 loans submitted this morning. One is a rush condo that's closing on the 21st, and one is a $1.2 million purchase with a first loan and a second loan, up to 95%,
Wow.
5% down on a 1.2, closing on the 20th.
Wow.
Closing on the 20th.
Wow.
So guys,
That's impressive.
you have no excuses. Let's get this done. We've got the team, we've got the underwriters, we're on the ready, and we're closing them fast. The other thing that this is the program that you need to know, the one that I was talking about in the beginning that you've got to have in your back pocket. It's bridge loans. So this is not your grandmother's bridge loan. This is a bridge loan that is so advanced. So yes, everybody knows that you can use a bridge loan for a home that you're selling. You have another home that you're buying. You're going to take the equity and you can go through a portfolio bank and you can do a bridge loan based on the equity. Now, those bridge loans, if you get them at a First Bank or another bank, a local bank, you're going to be restricted to your debt to income ratio. This bridge loan is a 12-month interest-only loan. We just got a clear to close on one with a 524% debt to income ratio.
What?
That doesn't even make any sense.
No.
They have very little
What?
income, but they're putting 40% down. They have all their equity. They don't owe anything on their current home. They're going to sell that home, hopefully very quickly, but certainly they have up to 12 months. They're going to sell that home and they're going to pay off this loan entirely.
Wow.
So they're not needing to qualify with their income. They're qualifying on the fact that they're putting 40% down, which gives us tons of leverage in case they don't sell. We have to foreclose, which I don't want to, or they just simply sell it, which is what they will do, and just turn around and sell it and pay off the loan. But as soon as they sell the home that they've got listed, they'll pay off this loan. But we're also doing it. We have another client that we're doing it based on tax returns that we need February of 2023. That one was 110% debt to income ratio based on income today, but it was going to be well within the limits based on the tax returns that were going to be done and submitted to the IRS in February.
Wow.
That's the creative financing that we're doing. We're not a bank. We actually hold these loans for 12 months interest only because OneTrust is so secure that we have access to the capital to be able to do this to support our clients, because this is a client that otherwise could not purchase a home, and we're going to get them into the home today and then put them into permanent financing as quickly as possible, and certainly within the 12 months. You guys have to know about this because we're doing it and we're doing a lot of them, and we can close those quick as well. another conversation that you need to be having, whether it's with your buyer or with your lender, hopefully this one, me, is the conversation. Everybody's been talking about the 3-2-1 and the 2-1 buy down, and it's a great conversation, and it proved well over the last couple of years. But I'm going to tell you, as rates go down, you should not be spending the money on a temporary 2-1 buy down, but looking at a permanent buy down. Because if you can save your client the hassle of refinancing again, and we're doing the no lender cost refinances, but there's still costs. There's a cost of transferring the escrow, or there's the title cost, or there's just, what's your hour worth, right? Your hour's worth something. The hassle of doing that again. So the 2-1 buy down, I just threw together a scenario, 6.25% interest rates today. Yes, you're going to save $13,000 if you knock it down to 4.25% year one, 5.25% year two. But I could take that same money and lock it in at 5.375. And depending on what rates do next year, that might be the normalized interest rate, because it's going to be in the low to mid fives. So look at this. Look at taking that seller credit right now in these 3 months where the buyers have the advantage, put that money into a permanent buy down and serve your clients. Give them the information they need to make the best decision to not have them refinance again. Yes, we're doing the no lender cost, but what if you didn't have any costs at all, or really any hassle factor? So we're looking at this with every single client that we're talking to. And given next week's information, as far as the PPI tomorrow, the CPI on Tuesday, and the Fed meeting coming out, raising the Fed rate on Wednesday, we're going to be using our text updates. So we do it standard on Friday, but we're doing it as needed based on this big news swing. So make sure to get signed up for our text updates so that we can alert you. We don't use it for any other reason other than to give you an update on the market movement and opportunities that your buyers need to know going, especially into selling or buying weekends. All right, here's your 3. Mortgage rates, specifically not being I'm blasting out mortgage rates every day, but what impact does that have on demand? I want to help you, the buyer, navigate this spring. And if I think the demand is lower now based on where interest rates are, and we all think interest rates are going to come down, more demand is going to come out, pushing up home prices, giving you really the risk of having an appraisal issue. Versus if we can get you in now, use seller credits for a permanent rate reduction, you'll never refinance and you'll lock in that home at a discount. That's the conversation. Or inventory, where has it been historically? What's expected to have happen? What's a normalized business or a normalized amount of inventory? Not this news about it being a balanced market or a buyer's market. Having conversations intelligently around the story of inventory, and then days on market, seeing the different days on market based on the price point and the speed the market is moving. Those are great conversations to be talking specifically to that price point of that homeowner if they're thinking about selling and becoming a buyer. And then lastly, if you guys have not bought your tickets yet, don't wait until the last minute. Of course, at the last minute, the ticket prices will go up. But not only, I just keep talking about all the speakers we got. Renee Rodriguez is a powerhouse when it comes to gaining trust quickly by speaking with authority and putting yourself in a position visibly of commanding that authority and control of a conversation. This is a thing you're not, oh my gosh, this man is a miracle worker on stage, and to show you that, and that can be on a one-on-one conversation. You don't have to be a speaker in order to capitalize on what he's going to be teaching us. And Ali Gabero is a story brand expert, and she's going to be talking about creating your story brand and your marketing going into 2023. The lineup is literally off the charts. All right, let's see. Look at that.
Got a couple of questions.
I didn't even run into the last minute.
I know.
Like we did last week. We did that. Tip, I have an alarm set on my phone to make sure my EV is plugged in. That's a beautiful, all right. Thank you, Lee. I need although I'd be really pissed off the other 5 nights because I only plug it in once a week, or the other 6 nights that I get that alarm. So I'd have to do it like once a week. What was the phone number for the text updates? That phone number is 855-930-0377. And can you repeat the update number? We did that. All right. You want to wrap us up?
Yeah, well, that takes us through another week with all of the data. And so thanks so much for tuning in. We had over 1,200 people on this call this week. And so people continue to migrate towards these reports. We'll be getting those out to you a little bit later today. And so Nicole probably sends her stuff out about 2:00 in the afternoon. I'll probably be closer to 2 o'clock this afternoon because I've got all of the monthly updates to get through today. And I want to try and minimize the number of emails that I send you guys. So I'll have one update that has the weekly reports and the monthly reports for November's all set out for you guys.
That's
Probably
a big deal,
around
because
2
your
o'clock.
monthly reports have the whole zip code.
Oh my gosh,
maps in them
yes.
too. I
And
mean,
so
just
I
tons of
spent
data
all
in
day
there.
Monday and I'm waiting for one data point. I'm waiting
Yes.
for the average interest rate for November to get those finalized. And so once I have that number published by Freddie, I'll be able to get all of those out to you. So I
Yep.
hope to have those out to you by about 2 o'clock this afternoon. So sit tight for me. It's going to take me a little bit longer to get those out. But as always, we so appreciate you tuning in with us every week. And we hope that you'll join us again next week where we have another 1,200 people signed up and registered for that report.
Love it.
And so thank you so much for tuning in. We really appreciate you guys, and we hope to see you very soon at our closing table. So please keep me, Megan Auger at First American Title in mind for your upcoming closings, and Nicole Ruth with One Trust Mortgage for your upcoming loans. So thank you so much for tuning in, guys, and we will catch you next week.
Thank you.
Have a
Bye-bye.
good weekend.